Hello. We talked about journal entries, posting, and unadjusted trial balance. Today we will talk about adjusting entries and adjusted trial balance. But before starting, please, if you are new to my channel, give me a like and subscribe and leave a comment. Step 5. Review the accuracy of the worksheets. This step is only necessary when the ending balance doesn't match up. Accounting errors usually happen from mathematical slips, incorrect posting, or inaccurate transcriptions. Whatever the scenario, a bookkeeper needs to find out where the error took place. For example, if debit amounts to $800 and credit to $1,300, there's $500 a bookkeeper should correct. With accounting software, on the other hand, it's a lot harder to make mistake. Let's move to step number 6. Make adjusting entries. After finishing with corrections, the next step is to make adjustments. Adjusting entries update previously recorded journal entries. The purpose is to ensure that the financial statements only have up-to-date and relevant information. There are 3 main types of adjusting entries: deferrals, accruals, and estimates. Deferrals are money you spend before getting any actual revenue or service. They include prepaid expenses and unearned revenues. A prepaid expense is when you pay now for a future asset, like insurance, while unearned revenue is cash received before doing the work, and it's recorded as a liability. An example would be your yearly newspaper membership. Accruals, on the other hand, are revenues and expenses you haven't immediately recorded. Accrued revenue is cash earned but not yet received. If a customer delays a payment for a month, that transaction is recorded as accrued revenue. Accrued expenses are the opposite, so expenses made but not yet paid. A common example is not paying your workers the salary until the end of the month. Lastly, we have estimates. Estimates are made for non-cash items when you can't identify the exact value of them. A typical estimate of a business is the depreciation expense. This expense is made for long-term assets like vehicles or equipment. Since the exact cost machinery suffers can't be measured in cash, there's a formula that estimates that depreciation. The amount is then separated over many accounting periods, depending on how long the asset's useful life is. Let's move to the example. Adjusting entries for prepaid expenses. Supplies. Pioneer Advertising purchased advertising supplies costing $25,000 on October 5. Prepare the journal entry to record the purchase of the supplies. Here we can see supplies and cash. Supplies is an asset, cash is an asset. Supplies increased, cash decreased. The entry is debit, supplies, credit, cash, $25,000. An inventory count at the close of the business on October 31 reveals that $10,000 of the advertising supplies are still on hand. Here we have to decrease the supplies and increase supplies expense. We have on hand $10,000, so the expense is $15,000. And the entry is debit, supplies expense, credit, supplies for $15,000. Here we can see supplies in the balance sheet in assets and supplies expense in the income statement. If you want to talk about insurance, on October 4th, Pioneer Advertising paid $6,000 for a 1-year fire insurance policy. Coverage being October 1. Prepare the entry to record the purchase of the insurance. When we purchase the insurance, we have prepaid insurance. It's an asset. Cash, also an asset. Prepaid insurance increased. Cash decreased. The entry debit prepaid insurance, credit cash. An analysis of the policy reveals that 506,000 divided 12 of insurance expires each month. Prepare the entry to record insurance cost expired in October. Here we have insurance expense increased and insurance as an asset decreased, and the entry debit insurance expense, credit prepaid insurance. And we can see here prepaid insurance in the balance sheet and insurance expense in the income statement. If we want to talk about unearned revenues, for example, Pioneer Advertising received $12,000 on October 2nd from KC for advertising services expected to be completed by December 31. Prepare the journal entry to record the receipt on October 2nd. On October 2nd, we have two accounts, cash and unearned revenue. Cash is an asset. Unearned revenue is a liability. It's increased. And the entry is debit cash, credit unearned service revenue. Analysis reveals that Pioneer Advertising earned $4,000 of the advertising services in October. Prepare the entry to record the revenue for service performed. Here we have service revenue and unearned service revenue. Unearned service revenue, it's a liability. It's decreased and the revenue increased. The entry debit unearned service revenue, credit service revenue for $4,000. Here we can see in the balance sheet unearned service revenue in liabilities, and the income statement we can see service revenue. Let's move to the accruals. Here we have accrued revenues. In October, Pioneer Advertising performed services worth $2,000 that were not billed claims before October 31. Prepare the entry to revenues for service performed. Here we have service performed, we have revenue, but we didn't receive it. So we have accounts receivable. The entry is debit accounts receivable, credit service revenue. Here we can see accounts receivable in the balance sheet and service revenue in the income statement. For accrued interest, let's see this example. Pioneer Advertising signed a 3-month note payable in the amount of $50,000 on October 1. The note requires interest at an annual rate of 12%. 3 factors determine the amount of the interest accumulation. We have face value, $50,000, annual interest rate, 12%, time in terms 1 year, it's 1 month, 1 divided 12. So the interest is $500. We didn't pay the interest, so the entry is debit interest expense, credit interest payable. And we can see interest expense in the income statement and interest payable in the balance sheet. For example, about accrued salaries and wages. At October 31, the salaries and wages for these days represent an accrued expense and a related liability to Pioneer. The employees receive total salaries of $10,000 for a 5-day work week, or $2,000 per day. Prepare the adjusting entry on October 31 to record accrual for salaries. Here we have on October, Monday, Tuesday, Wednesday, 29, 30, 31. We won't pay them till next month. So we have accrued salaries for $6,000. for 3 days. The entry debit salaries and wages expense, credit salaries and wages payable for $6,000. On November 23, Pioneer will again pay total salaries and wages of $40,000. Prepare the entry to record the payment of salaries on November 23. Here we will pay in cash $40,000. We have $6,000 from last month, and for this month we have $34,000. And the entry we have debit salaries and wages payable $6,000, salaries and wages expense $34,000, credit cash $40,000. For estimates, we can see depreciation. For example, Pioneer Advertising estimates depreciation on its office equipment to be $400 per month. Prepare the entry to record depreciation for the month of October. Here we have depreciation expense and accumulated depreciation. Depreciation expense increased. Accumulated depreciation is a contra account for assets, also increased. So the entry debit depreciation expense, credit accumulated depreciation for $400. And we can see the equipment less accumulated depreciation in the balance sheet and depreciation expense in the income statement. Another entries for estimates, we have bad debit. Pioneer Advertising estimates a bad debit expense for the month of $1,600. Prepare the entry to record the bad debits for the month on October. Here we have bad debit expense and allowance for doubtful accounts. The entry is bad debit expense, credit allowance for doubtful accounts. And we can see bad debit expense in the income statement and accounts receivable less allowance in the balance sheet. Now that you are done with making adjusting entries, it's time to put them in a new trial balance. This one again done to prove that debits and credits balance in the end. Here we can see adjusted trial balance for Pioneer Agency Inc. Shows the balance of all accounts after adjusting entries at the end of the accounting period. More details we will take about financial statements. This is all for today. See you in the next video.